And I'd really briefly like to just address just a couple of points and really go into sort of the way commodity trading used to be and the way it is today. And it's much different today than it was in the past. But first of all, really the only idea that I'm talking about today, and I've talked about in the past, I've testified before Congress on this subject, and during my day job as a hedge fund manager, is the idea that money actually influences prices, which as a hedge fund manager is almost laughably simple to think about. Without actors acting on the quote-unquote fundamentals, there is no price formation. The idea of fundamentals moving the markets, there is no fundamental movement of markets unless human beings act on those fundamentals for or against and decide actually to spend the money and act in the markets, which then adjust the price. Now, some people say, well, how can speculators really have any impact on the price? How can financial actors have any impact on the price of commodities? And it's just like any other market, because there's a buyer and a seller for every transaction. In fact, indeed, the definition of a transaction is a buyer and seller, and we know that's occurred throughout history. And yet we also know that prices move. So clearly, just having a buyer and seller does not infer that prices don't move. So how then do prices move? Well, prices move because the only function of markets is to allocate via price. That's how prices move. And markets adjust price to accommodate new demand or new supply. That's why markets go up and down, because new dollars come into a market, the price adjusts to incent new sellers to come in the market, and when the price falls, or when new sellers come into the market must reduce price to incent new buyers to take up the slack. After all, these new buyers and sellers aren't doing this for free, just like in any other business. They need a price incentive to do this, and so that's what markets do. And I think that is sometimes missed on people that are non-market participants, the way actually prices move. They don't move by themselves. They only move because people take action by buying or selling. So let me just talk a little bit about briefly about the differences in between the past regime. I'm from the United States, and we have a commodity regulator, a separate regulator there, a CFTC. We have an SEC for securities regulation. Of course, as Judith mentioned, commodities are different. They're not capital assets. And in fact, one of the issues I think with investors today is that just because you can pull up commodities on a Bloomberg, just like you can equities or debt instruments, it doesn't mean they're the same. In fact, the only value in commodities ultimately is in consumption. They do not provide any cash flow like capital assets. Capital assets have the attribute of providing cash flow, interest payments, cash flow from companies, interest payments as it relates to debt for real estate, rents. But in the case of commodities, the only value is to buy them and resell them at a higher price. One cannot do anything with them from a cash flow basis other than just consume them. And so it's an odd thing that we have gotten people to invest in commodities, not as a speculation, as buying and selling, but actually to own commodities for very long periods of time, effectively synthetically hoarding commodities via the futures markets and owning these commodities for some kind of portfolio diversification, because after all, they're not actually capital assets. And to go back in the past, the commodity markets used to be, in the United States, about 20% speculators. And speculators are necessary. They're there to fulfill a function, and they're there to help hedgers deal with price risk. They were, for many, many years, 40 or 50 years, 20 to 25% of the open interest, which is sort of the ownership of a commodities market. And the speculator, or the hedgers, were the great majority, 70, 75%. Now, things change. And in the year 2000, the U.S. changed the rules of the commodities futures markets through the passage of the Commodity Futures Modernization Act. And that opened up a whole new market, a whole new framework for trading commodities. And it opened up over-the-counter markets as viable alternatives to listed exchanges. In the past, when speculators were a limited amount of the activity, the activities of hedgers who were acting more like fundamental investors, because after all, they're hedging their crop, or they're hedging their crop conditions, or what they're looking for, dominated that pricing activity when they were the majority. But once after the passage of the Commodity Futures Modernization Act, and today, the tide turned. And so now these markets are 70 to 75% speculative. The speculators have gone way past the idea of just providing liquidity. Now they're actually affecting price formation in a significant manner. And that price formation may be because of things that are non-related to the supply and demand conditions of the commodity itself, and that's the crucial point. Because if the price of oil is going up because the S&P 500 is going up, or the price of corn is going up because of the S&P 500 is going up, and these assets are now correlated because of new algorithmic trading strategies that have the idea of correlating these strategies together, then we have a much different issue. Now commodities are not trading based on supply and demand, but they're trading based on the mandate of institutional investors. And so we have a different regime. And so in 2010, the Dodd-Frank legislation passed, in large part to change the nature of the completely unregulated derivatives market prior to 2010. And there were some changes in the commodities markets as well. And so the CFTC passed a regime where they would not just deal on exchanges, but they would now also deal on the over-the-counter markets. And that's critical because the over-the-counter markets, many people say, are much larger than the listed markets. And among the things they did was they put position limits on over-the-counter markets, not just listed markets. And the reason that's important here for the Parliament is Marcus Ferber, he said, you know, I haven't talked to any experts yet who have told me how we can do the position limits on the over-the-counter market. Well, the CFTC, I don't know if he talked to the CFTC on this subject, but the CFTC has a regime in the present past position limit regulation that actually looks at over-the-counter markets and uses something called, in the reporting of over-the-counter transactions, something called listed hedge equivalents, which is critical. Without using listed hedge equivalents, it is impossible, as Mr. Ferber suggested, to be able to compare apples and oranges, to be able to compare one market to another. But with listed hedge equivalents, then one has to report all their trades in the same vernacular. So if one is doing a $500 million oil swap, for instance, one has to say in the reporting regime mandated by the CFTC, I am buying what the swap entails. There's an interest rate component of the swap, and I'm also putting in maybe 7,000 Brent crude futures contracts. So I put that together, and now I have a reporting regime, and I report that to the regulatory authorities. So there's a few differences, and I don't want to run over my time, but I just wanted to just sort of talk about there's vast differences between the former and today, and the markets themselves. Thank you.